Hey there, and welcome back to the Deep Dive. This is the show where we take your pile of information, really sift through it, and pull out those key insights. We turn the complex stuff into clear, usable knowledge for you.
Exactly. No drowning in data here.
Right, just the good stuff you need to be genuinely well-informed. And today, wow, we are plunging into a world that sounds, well, maybe a bit dry. Auditing.
It might sound dry, but it's fascinating, really. You've given us a great stack of materials, professional standards, internal controls, audit engagements, reporting, the whole 9 yards.
It's quite the stack.
Yeah, and our mission today is simple. Cut through the jargon, connect the dots for you, and show why these intricate processes are so vital for trust and transparency in finance. We're going to make sure every part is explained clearly, really easy to grasp.
Okay, let's get into it then. Our goal for this deep dive: demystify how financial statements get verified. What do auditors actually do? And what do all those different reports mean for you, the person actually using that information?
Think of it like a backstage pass. Yeah. Exactly. A behind-the-scenes look at financial integrity, ready to uncover some insights.
Let's do it.
So let's kick things off with the absolute core idea. Why does auditing even matter? What's the main mission?
Well, at its heart, the auditor's primary job is to get what's called reasonable assurance.
Reasonable assurance.
Reasonable assurance about whether the company's financial statements are free from material misstatement. Now, that misstatement could be an honest mistake, an error, or it could be, deliberate fraud.
Material misstatement.
Mm.
We'll probably need to unpack material a bit later, too.
Absolutely. And this reasonable assurance concept is key. It's a high level of confidence, definitely.
Okay.
But it's crucial to understand it's not absolute. It's not a 100% guarantee.
So not perfect certainty.
No, think of it like a really thorough quality check, not inspecting every single nut and bolt. They look at a lot, but not everything. The ultimate goal, though, is crystal clear: to give an independent opinion.
Independent. That sounds important. Critical. An opinion on whether those financial statements give a true and fair picture of the company's financial health, all according to the established accounting rules, the framework.
That's the key, isn't it? An independent opinion. So that's why you can generally trust audited financials, because someone unbiased, following strict rules, looked them over.
Precisely.
But who sets these rigorous standards? Who actually writes the rule book for auditors?
Good question. There are a few main standard setters depending on the type of company. For audits of non-issuers, think private companies, mostly the rules are the SASS, Statements on Auditing Standards from the AICPA.
Okay, AICPA for private.
Then for issuers, those are public companies, the ones registered with the SEC. Their audits follow PCAOB-AS, the Public Company Accounting Oversight Board Auditing Standards.
PCAOB for public. Got it.
And finally, if you're auditing government organizations, programs, that sort of thing, you use GAGA's, Generally Accepted Government Auditing Standards from the Government Accountability Office, or GAO.
GAGAs for government. Makes sense.
And these standards are fundamental because they ensure consistency, quality, a level playing field. That's what builds public trust. Without them, it'd be the Wild West.
Right, like having different rules for different leagues, but all aiming for fair play. And I gather even within those rule books, there's a kind of hierarchy. Like some rules are absolute must-dos, and others are more like strong suggestions.
Exactly right. In the GIAS hierarchy, language is really important. If a standard uses the word should, that signals a presumptively mandatory requirement.
Presumptively mandatory.
Meaning auditors must follow it, unless, and this is rare, there's a justifiable reason not to, and they have to perform alternative procedures and document everything thoroughly.
So a very high bar to deviate.
Very high. Other words like may, might, or could, they indicate explanatory material. It's helpful guidance, but it doesn't impose a professional requirement.
More like helpful hints.
Sort of. And below that, you have things like interpretive publications, AICPA audit guides, for example. They offer recommendations on how to apply the shoulds. Auditors should consider them, but they aren't standards themselves. This layering shows the real care and judgment involved.
Wow, so it's not just number crunching. It's navigating this really detailed, structured framework. And speaking of care, let's talk ethics. Independence sounds like the absolute bedrock here. Why is it so non-negotiable?
It truly is the foundation. The AICPA Code of Professional Conduct demands independence for audits. And for public companies, the Sarbanes-Oxley Act, SOX, gets even more specific.
SOX, right. They came after some big scandals.
Exactly. It really tightened things up. SOX prohibits auditors from providing certain non-audit services to their audit clients, like bookkeeping or designing their financial systems. The idea is to avoid conflicts of interest.
Can't audit your own work, basically.
Precisely. SOX also mandates that lead audit partners rotate off an audit every 5 years, and there's a cooling off period. The audit firm can't have recently employed the client's CEO, CFO, or similar top finance execs in a financial oversight role for a year before the audit.
So multiple layers to keep that distance and objectivity.
Yes. They use what's called the conceptual framework approach. Auditors have to constantly identify potential threats to their independence, like having a financial stake in the client or becoming too friendly, too familiar with management. If they spot a threat, they have to evaluate how significant it is and apply safeguards to eliminate it or at least reduce it to an acceptable level. But some threats, like the management participation threat, where the auditor essentially starts acting like management, are so fundamental that no safeguard works. You just can't do the audit then.
So you can't cross that line.
Never. Because without that solid independence, the auditor's opinion loses all its credibility. It becomes worthless to you, the user, trying to make decisions based on it.
Okay, this is where it gets really interesting for me. Even with all these rules, audits have inherent limitations. You mentioned it's not a flaw, but a reality check. What does that mean for us users?
It means understanding what an audit can and cannot deliver. While it provides that high level of reasonable assurance, it's not absolute assurance. There are some very practical reasons why.
Okay, like what?
Well, first, the nature of financial reporting itself. It involves judgment. Think about estimating how long a machine will last, or the value of, say, intangible assets. These involve subjectivity and uncertainty.
Right, not everything is black and white numbers.
Exactly. Second, the nature of audit procedures. There are practical limits. Auditors don't have, like, police powers to subpoena anything they want, and management might not provide complete information, sometimes unintentionally, sometimes not. Plus, fraud, by its nature, is designed to be hidden. It can be really cleverly concealed.
So auditors aren't forensic investigators with unlimited resources.
Not typically, no. And finally, there's the timeliness and cost-benefit balance. You need financial reports relatively quickly, right, to make decisions.
Yeah, timely info is key.
So there's a trade-off. Auditing absolutely everything would take too long and cost too much. You have to strike a balance between the benefit of extra checking and the cost and time involved. Understanding these limitations is crucial. It means you rely on the audit, but you know it's not a perfect guarantee against any possible misstatement. It's about realistic expectations.
That makes a lot of sense. It's a high level of assurance, not a perfect shield. Okay, with that foundation, let's walk through the audit lifecycle. How does it actually start getting the gig, so to speak?
It begins with engagement acceptance. And for public companies, the audit committee is central here. This committee is part of the board of directors, independent from the company's management.
Independent, okay.
They are the ones who select and appoint the independent auditor. They negotiate and approve the audit fee. They oversee the whole relationship. Critically, the auditor reports to the audit committee, not to the CEO or CFO.
So the auditor's true client is the committee representing the shareholders, not the managers running the company day to day.
That's the principle, exactly. Once the auditor is chosen, the terms are formalized in an engagement letter. It's a written contract.
Like any professional service.
Right. It spells out the auditor's responsibilities primarily, expressing that opinion on the financial statements and also management's responsibilities.
What are management's responsibilities in this?
Management is responsible for actually preparing the financial statements fairly, for designing and maintaining effective internal controls, and crucially, for giving the auditor access to all relevant information and personnel. That letter sets the ground rules, the expectations.
Establishes trust and accountability from day one. What if it's a new auditor taking over? Is there a handoff?
Oh, yes, absolutely required. The incoming auditor, the successor, must contact the previous auditor, the predecessor.
Must, not just should.
Must. But they need the client's permission first to allow the predecessor to speak freely. If the client refuses permission, that's a huge red flag.
Yeah, I'd wonder what they were trying to hide.
Exactly. The successor auditor would seriously consider withdrawing from the engagement, or at least think very hard about the implications.
Okay, engagement accepted, letter signed. Now, planning. You said this is like the detective preparing their case?
That's a great way to put it. After accepting, the auditor must get a really thorough understanding of the client's business and industry. What are the specific risks? Unique accounting practices. They use industry guides, trade journals, economic reports, you name it.
So they need to become mini experts in the client's world.
Pretty much. This knowledge shapes the audit strategy. That's the overall game plan. What's the scope of the audit? What are the reporting objectives, the timing, the key areas to focus on? Factors like the company's size, complexity, reliance on IT, prior audit results all feed into this strategy.
And a huge part of planning is assessing audit risk, right? The chance the auditor messes up and gives a clean opinion when the statements are actually materially wrong. How do they break that down?
Right. Audit risk is the big one they manage. Think of it as an equation. Audit risk equals the risk of material misstatement, RMM, multiplied by detection risk, DR.
Okay, RMM times DIR. What's RMM?
RMM is the risk that the financial statements are already materially misstated before the audit even begins. It has two components itself: inherent risk, IR, and control risk, CR.
Inherent and control risk.
Yeah. Inherent risk is the susceptibility of an account or assertion to misstatement just based on its nature, assuming there were no controls. Think complex calculations, assets hard to value, industries undergoing rapid change.
Things that are just naturally risky.
Exactly. And control risk is the risk that the company's own internal controls will fail to prevent or detect and correct a material misstatement on a timely basis.
So how good are the company's own safeguards?
Right. Now, the auditor assesses IR and CR, but they can't directly change them. Those belong to the client and their environment. The part the auditor can control is detection risk, DR. That's the risk that the auditor's own procedures won't catch a material misstatement that exists.
So DR is about the effectiveness of the audit itself.
Correct. And here's the key relationship. It's inverse. If the auditor assesses the RMM, inherent risk times control risk, as high,
Meaning there's a higher chance the financials are already wrong.
then they must set detection risk low. To set DR low, they have to perform more audit work or more effective, more persuasive procedures. They have to gather stronger evidence to compensate for the higher initial risk.
More risk going in means the auditor needs to do more digging to lower their own risk of missing something. Got it.
Perfectly put.
What about the F word? Fraud. How does that fit into planning?
It's a major focus. Auditing standards require auditors to specifically assess the risk of material misstatement due to fraud in every audit. They have to maintain professional skepticism.
You can't just assume everyone's honest.
No. And remember the key distinction. Fraud is intentional deception, while error is unintentional. Fraud might involve cooking the books, stealing assets, omitting key information. Audit teams have mandatory brainstorming sessions to discuss where the company might be vulnerable to fraud and how they'd respond. A huge risk area is always management override of controls.
Where the bosses just ignore the rules they set for everyone else.
Essentially, yes, because they often have the authority to do so.
Okay, and one more planning concept.
Yeah.
Materiality. We touched on it. It's not just a dollar number, right?
Definitely, no, it's a crucial judgment call. A misstatement is material if it's probable that it would influence the decisions of a reasonable person relying on the financial statements. It involves both quantitative, the actual dollar amount, and qualitative factors.
Qualitative. Like what?
Like maybe the amount is small, but it changes a loss into a profit, or allows the company to meet loan covenants, or triggers management bonuses, or helps hide an illegal act. Those qualitative aspects can make a small amount material. It's context dependent. And remember, clearly trivial is a much, much lower threshold than material. Auditors track anything above clearly trivial.
So a lot of judgment involved there. And auditors test specific assertions, claims management makes about the numbers.
Yes. Instead of just looking at the final balance, say, for accounts receivable, auditors test the underlying assertions management is making about that balance. There's a handy mnemonic, cover-up, though some variations exist.
Cover up. Okay, let's hear it.
Completeness. Is everything included that should be? Off. Cut off are transactions recorded in the correct period. Valuation, allocation, accuracy. Are amounts recorded correctly? Existence and occurrence. Do the assets really exist? Did the transactions actually happen? Rights and obligations. Does the company actually own the assets? Are the liabilities really their obligations? Understandability of presentation and classification. Is everything presented clearly and categorized correctly?
Wow, that covers a lot. So they design tests for each relevant assertion for each major account.
Exactly. This systematic approach ensures they cover all the key risks associated with each number on the financial statements. This planning phase is absolutely critical. Understanding the business, the risks, the controls, and designing tests for those assertions sets the stage for the entire audit.
All right, planning done. Now let's talk internal controls. You mentioned the COSO framework and the crime mnemonic. Not actual crime, but the components of good control.
Right, not literal crime. COSO is a widely accepted framework for designing and evaluating internal control, and crime helps remember the 5 interconnected components. It's all about providing reasonable assurance for objectives like reliable financial reporting.
Okay, lay out crime for us.
C is the control environment. This is the foundation, the tone at the top. Management's integrity, ethical values, their philosophy, how they assign authority. If the control environment is weak, it poisons the well for everything else.
That's the whole mood, basically.
Pretty much. R is risk assessment. This isn't the auditor's risk assessment, but management's process for identifying, analyzing, and managing the risks they face in achieving their objectives, including fraud risk.
So how does the company itself identify its own dangers?
Exactly. R is information and communication. How does relevant information, financial and non-financial, get identified, captured, and communicated throughout the organization and also externally?
The flow of info.
M is monitoring activities. These are ongoing or separate evaluations management uses to check if the internal controls are present and functioning effectively over time, like internal audits or regular supervisory reviews.
Checking that the controls are actually working.
And finally, the second C is existing control activities. These are the actual policies and procedures that help ensure management's directives are carried out. These are the specific actions taken to address risks.
Okay, these sound like the practical day-to-day things. Examples.
Tons. Approvals, authorizations, verifications, reconciliations, reviews of performance, security of assets, and, crucially, segregation of duties.
Yes, segregation of duties. You mentioned ARC earlier.
That's right, a key control activity. To prevent one person from being able to both perpetrate and conceal errors or fraud, you need to separate incompatible duties. Think authorization, record-keeping, and custody of assets.
So the person who approves a purchase order shouldn't be the one who receives the goods and pays the bill.
Ideally, no. The person holding the cash shouldn't also be the one recording cash transactions. That separation makes fraud much harder. Now, controls can be preventive stopping problems before they happen, like requiring a password.
Or locking the warehouse.
Right. Or detective finding problems after they occur, like reconciling the bank account or reviewing exception reports. Both are important, but remember, like audits, internal controls have inherent limitations.
They're not foolproof either.
No. Management can override them, people can collude to circumvent them, and simple human error happens. So auditors assess controls, but they know controls aren't a guarantee. Still, strong controls definitely increase the reliability of the financial information you rely on.
Okay. Auditor understands the plan, assesses the controls. Now, the real field work, gathering evidence. What makes evidence good?
Auditors need sufficient and appropriate evidence. Sufficient means enough evidence. Appropriate means the evidence is both relevant, related to the assertion being tested, and reliable.
Reliable. Is some evidence considered more reliable than others?
Oh, absolutely. There's a hierarchy. The most reliable is usually the auditor's direct personal knowledge, what they see, touch, calculate themselves. Observing inventory count, for example.
Makes sense. Seeing is believing.
Then, external evidence obtained directly from independent third parties is highly reliable. Think bank confirmations sent straight to the auditor.
Better than getting it from the client.
Generally, yes. Internal evidence provided by the client is more reliable if their internal controls are strong. And usually, documentary evidence, paper or electronic, is more reliable than just talking to someone, oral evidence. Consistency matters too. If evidence from different sources points the same way, it's stronger.
Like corroborating witnesses. So what are the actual procedures, the tools they use to get this evidence?
It's a mix. Inquiry, asking questions. Very common, but usually needs corroboration. Analytical procedures, studying relationships in financial and non-financial data. Required in planning and final review, often used substantively too.
Looking for trends, anomalies.
Exactly. Inspection, examining records, documents, or tangible assets. Observation, watching a process being performed by others. External confirmation, getting direct responses from third parties. Recalculation, checking math. Reperformance, independently doing a control procedure the client did.
Quite a toolkit.
Yeah.
Now, you mentioned vouching versus tracing earlier as being key for testing assertions. Can you break that down really clearly?
Yes, this is fundamental. Think about the direction. VO-seaching starts with a number already in the financial statements, like recorded sales revenue, and goes back to the supporting documents, invoice, shipping doc.
So, from the books back to the source.
Right. The question is, does this recorded item actually exist? Did this sale actually occur? So vouching primarily tests existence or occurrence. It fights against overstatement.
Okay, vouching proves it's real. What about tracing?
Tracing goes the other way. You start with the source documents, like shipping documents showing goods went out, and go forward to the financial statements.
From the source forward to the books.
Yes. The question is, was everything that should have been recorded actually recorded? Did this shipment get recorded as a sale? So, tracing primarily tests completeness. It fights against understatement.
Got it. Vouching. Existence, is it real? Tracing, completeness, was it missed?
Yeah.
That's clear. But they can't vouch and trace everything, right?
Hmm.
That's where sampling comes in.
Exactly. Examining 100% is usually impossible or impractical. So auditors use sampling. There are different types. Attribute sampling is often used for tests of controls, like testing a sample of purchase orders to see how many lacked proper approval. It estimates a rate of deviation.
How often the control failed.
Right. Variables. Sampling is typically used for substantive tests of details, like estimating the total dollar amount of error in accounts receivable by examining a sample. Probability proportional to size, PPS, sampling is a neat hybrid often used for dollar value testing. It cleverly gives bigger items a higher chance of being selected.
Makes sense to focus more on the bigger items. And now, the high-tech stuff, audit data analytics, ADAs, how are they changing the game?
Significantly. ADAs let auditors analyze huge populations of data, sometimes 100% of transactions, using sophisticated tools. They're used everywhere. Risk assessment, testing controls, substantive procedures, final review.
So what can they actually do?
Well, descriptive analytics tell you what happened. Summaries, frequencies. Diagnostic analytics explore why it happened, drilling down into variances, finding correlations, using fuzzy logic to find near matches that might indicate errors or fraud.
Going beyond just summarizing.
Yeah, and then there's predictive analytics, what might happen using regression, forecasting, and prescriptive analytics, how to make something happen, like optimization, but a huge caveat.
Let me guess. Garbage in, garbage out.
Precisely. The analytics are only as good as the data, so auditors spend significant effort testing the data reliability. Is it complete, accurate, relevant? They might trace data back to source systems, test IT controls, reconcile totals, and data visualization is key. Turning complex results into charts and graphs makes insights jump out. It's definitely blending old school judgment with new school tech.
Fascinating. Okay, let's follow the money through some specific financial cycles. Where does the auditor focus? Start with the revenue cycle, sales, receivables, cash coming in.
Big area for risk. Common fraud risk is overstating revenue recording sales too early, fictitious sales, or just plain stealing cash receipts. Strong controls are vital. Good segregation of duties between sales orders, credit checks, shipping, billing, cash handling, and recording receivables. Approvals for write-offs. Lockbox systems are great.
Lockbox. What's that prevent?
It's where customers mail payments directly to a bank P.O. box. The bank deposits the cash and sends the remittance info to the company. It's a great control against lapping.
Lapping. That's the scheme where someone pockets cash from customer A, then uses cash from customer B to cover A's account later, and so on.
Exactly. A lockbox makes that almost impossible. For receivables, auditors often use confirmations. Positive confirmations ask the customer to reply whether the balance is right or wrong, more reliable. Negative confirmations only ask for a reply if it's wrong. Used less often, only in low-risk situations.
Okay, revenue covered. What about the expenditure cycle, purchases, payables, cash going out?
Similar themes. Segregation of duties is key. Separating purchasing, receiving goods, recording the payable, accounts payable department, and actually dispersing the cash, treasurer. A critical audit procedure here is the search for unrecorded liabilities.
Looking for bills the company hasn't booked yet.
Precisely. They examine payments made after year-end, plus unmatched receiving reports and invoices around year-end to see if anything relates to the period being audited but wasn't recorded. Interestingly, confirming accounts payable isn't required like receivables, partly because you usually have external vendor invoices as strong evidence, but you might do it if controls are weak. The catch is confirmations only verify recorded payables. They don't find the unrecorded ones, which is the bigger risk here.
Good point. What about the cash cycle itself? Any specific risks?
Cash is always tempting. Besides lapping, there's kiting. That's manipulating bank transfers near year-end to make the cash balance appear higher than it is. You record the deposit in Bank B immediately, but delay recording the disbursement from Bank A until the next period.
Playing the float across banks.
Right. Auditors use bank confirmations to verify year-end balances, loans, lines of credit, any special arrangements.
And quickly, what about other cycles like inventory or investments?
For inventory, observing the physical count is key. Auditors focus on identifying obsolete or damaged goods that need write-downs, affecting valuation. For investments, especially complex ones, fair value measurements are a hotspot. They look at level 1 inputs, market prices most reliable, level 2 observable inputs, and level 3 unobservable subjective inputs most risky. They scrutinize management's assumptions for level 3.
And things like property, plant and equipment, PPE, or payroll.
For PPE, focuses on authorizing big purchases and disposals, making sure retired assets are removed. For payroll, again, segregation of duties, HR, timekeeping, prep, distribution is vital, plus testing accuracy of pay calculations and deductions. Understanding these cycles shows how auditors trace the economic activity, looking for potential problems everywhere money moves.
We've followed the process, the planning, the evidence. Now the finale, the audit opinion. What does the auditor actually say?
This is the culmination, the report card. There are 4 main types of opinions. The best is an unmodified or unqualified opinion. That's the clean one. It means the financial statements present fairly in all material respects, according to the rules.
That's what everyone wants to see, the gold star.
Absolutely. Then you might get a qualified opinion. This means, except for the effects of some specific issue, the statements are presented fairly. This happens if there's a material misstatement, or the auditor couldn't get enough evidence on a specific part, but the issue is not pervasive.
Not pervasive, meaning it doesn't taint the whole picture.
Exactly. Which brings us to an adverse opinion. This is bad news. It means the financial statements do not present fairly. This is issued when misstatements are both material and pervasive. The whole structure is unreliable.
So pervasive means it's so significant it affects numerous accounts or fundamentally misrepresents the company's position.
That's a good way to put it. It's not isolated. It contaminates the overall usefulness. Finally, there's a disclaimer of opinion. Here, the auditor states they do not express an opinion at all.
Why would they do that?
Usually because of a major scope limitation that's material and pervasive, they were prevented from doing crucial procedures and couldn't gather enough evidence to form any opinion, or in rare cases where they are required to report despite not being independent. Knowing these types is key for you to interpret the auditor's message.
Definitely. Now, for public companies, the report itself has more detail, right? Especially critical audit matters.
Yes. For public company audits regulated by the PCAOB, the report must include critical audit matters, CAMs, unless there are none. CAMs are matters communicated to the audit committee that were especially challenging, subjective, or complex for the auditor.
So not necessarily problems, but the toughest judgment calls the auditor had to make.
Precisely. They relate to material accounts or disclosures and highlight areas requiring significant auditor judgment. Think complex estimates, new accounting standards, unusual transactions. It's expected that most public company audits will have at least one CAM. Importantly, including a CAM does not change the overall opinion.
It's extra transparency for the user, showing where the auditors really earned their fee, so to speak.
You could say that. It gives you insight into the complexity behind the opinion.
What if there are important things to highlight, but they don't rise to the level of qualifying the opinion? Are there other ways auditors flag things?
Yes, particularly in reports for non-issuers, private companies. They can use emphasis of matter paragraphs. This draws attention to a matter that is appropriately presented or disclosed in the financial statements, but is so fundamental to users' understanding that the auditor wants to highlight it.
Like what kind of matter?
Maybe substantial doubt about the company's ability to continue as a going concern, a major catastrophe after year-end, or an unusually important subsequent event. The key is, the accounting disclosure itself is correct. The auditor is just pointing a spotlight at it.
So read this footnote carefully.
Pretty much. Then there are other matter paragraphs. These refer to matters other than those presented or disclosed in the financials, but are relevant to understanding the audit, the auditor's responsibilities, or the report. For example, if the prior year was audited by someone else and their report isn't included.
Providing extra context about the audit itself.
Yeah.
Okay, and what about things happening after the balance sheet date but before the report is issued? Subsequent events.
Crucial area. Auditors have responsibilities here. There are 2 types. Type 1, recognized. Events provide evidence about conditions that existed at the balance sheet date. Like a customer going bankrupt shortly after year-end confirms their receivable was likely impaired at year-end. These require adjusting the financial statements.
So you update the numbers.
Yes. Type 2 non-recognized events reflect conditions that arose after the balance sheet date, like a fire destroying inventory after year-end or issuing new stock. These don't change the year-end numbers, but usually require disclosure in the footnotes so users aren't misled.
Disclosure, but no adjustment.
Right. The auditor actively searches for these events up until the date they sign the report. If something significant comes up after the report date but before the financials are issued, they might need to dual date the report, keeping the original date for most things, but adding a later date specifically for the new disclosure.
Covering themselves for that late breaking news. And if management refuses to deal with a significant subsequent event properly,
Big problem. The auditor would have to consider modifying the opinion or even withdrawing and potentially notifying regulators or users that the report shouldn't be relied upon.
serious stuff. And when we see comparative financial statements multiple years side by side, does the auditor reevaluate the opinion on the older years?
Yes, the report covers all years presented. The auditor considers if anything learned in the current year affects the opinion they gave on the prior years. They might reissue the same opinion, or they might update it, reaffirm, or change it based on new info. It ensures the opinions presented are currently appropriate.
Okay, that covers the standard audit reports. But auditors do more specialized work too. Let's touch on a few. Integrated audits for public companies.
Right. Required by SOX for larger public companies, it's integrated because the auditor performs both an audit of the financial statements and an audit of the company's internal control over financial reporting, ICFR.
So two opinions in one report.
Essentially, yes. One on the financials, one on the effectiveness of ICFR. It provides a deeper level of assurance, specifically on the control systems. If they find a material weakness in internal control, they have to issue an adverse opinion on ICFR.
More confidence for investors in the underlying systems.
Mhm.
Makes sense. What about attestation engagements? You said they're broader.
Much broader. They fall under different standards, SSAEs. Instead of just historical financials, the CPA provides assurance on some other subject matter or an assertion about it, like attesting to compliance with regulations, effectiveness of controls at a service organization, or even prospective financial information like forecasts.
Different levels here too.
Yes, an examination provides reasonable assurance, high level, like an audit, and requires independence. A review provides limited assurance, moderate level, based on inquiry and analytics, and also requires independence. Then there are agreed upon procedures, AUP engagements.
Yeah.
Here, the CPA performs only specific procedures that the client and maybe a third party have agreed on and reports the factual findings. No opinion, no conclusion, just here's what we did, here's what we found. Independence is required for AUPs too.
And you mentioned forecasts versus projections.
Key distinction in prospective financial info. A forecast is based on management's expected future conditions. It's for general use, anyone can see it. A projection is based on hypothetical what-if scenarios. It's for limited use only, like negotiating a specific deal based on certain assumptions. Attestation really shows the versatility of CPA services.
Now, shifting gears to public money. Government audits under GIGAS, the Yellow Book. What's different?
Higher standards, broader scope. GIGAS audits, often called Yellow Book audits, build on standard auditing principles but add requirements. Auditors usually report not just on financials, but also on compliance with laws, regulations, contracts, and grants, and also on internal control over financial reporting.
More reporting required.
Yes, and GIGAS also covers performance audits, which evaluate the economy, efficiency, and effectiveness of government programs. Are they achieving their goals? Using resources wisely. GIGAS also explicitly requires auditors to consider abuse, improper conduct that doesn't necessarily break laws but wastes resources, alongside fraud and illegal acts, higher accountability for taxpayer funds.
And single audits
Yep.
for entities getting federal money.
Right. If a non-federal entity, like a university, nonprofit, or local government, spends $750,000 or more in federal awards in a year, they generally need a single audit under the uniform guidance.
What's unique there?
The big thing is materiality. It's assessed separately for each major federal program, not just the entity's financials overall. An auditor might zero in on a relatively small grant program if it's deemed major based on specific criteria. It also requires detailed testing of controls over compliance with the rules of those major programs. Very granular review focused on how federal money is used.
Makes sense when federal funds are involved. Lastly, For private companies that don't need a full audit, there are SR's engagements. What options exist there?
Right. SRs stands for Statements on Standards for Accounting and Review Services. These apply to unaudited financials of non-issuers. The lowest level is preparation. The CPA just helps prepare the statements based on management's info. No assurance is provided at all. It's a non-attest service, so independence isn't required. But each page must state, no assurance is provided.
Basically formatting the data management gives them.
Pretty much. Next is compilation. The CPA assists management in presenting financial statements. Still no assurance provided. Independence is not required, but if the CPA isn't independent, they must disclose that in their compilation report. They don't verify the info. A report is always issued.
Okay, preparation and compilation, no assurance. What's the step up?
That's a review. Here, the objective is to obtain limited assurance that there are no material modifications needed for the statements to conform with the accounting framework. It's based primarily on inquiry and analytical procedures, significantly less scope than an audit.
Limited assurance. So some comfort, but not audit level.
Exactly. Independence is required for a review. A review report is issued, providing that negative assurance, basically saying, based on our review, we're not aware of any material modifications needed. These SR services offer different levels of CPA involvement for private companies, depending on their needs and budget. So if we kind of pull this all together, connect it to the bigger picture, what we've really unpacked today is this incredible spectrum of services accountants provide, all designed to make financial information more trustworthy.
Yeah, from the super intense regulated public company audits.
Right down to the more tailored services like reviews or compilations for private businesses. But that common thread, that commitment to professional standards, to ethical conduct, especially independence that underpins everything, it's all about providing that essential layer of confidence.
That's absolutely right. And what's really fascinating when you dig in is that auditing, at its core, it's really about establishing confidence, isn't it? It's this disciplined, evidence-based process that allows you, the person looking at these numbers, to make better, more informed decisions.
It's not promising perfection.
No, it's not about catching every single tiny error. It's about giving that reasonable assurance on the material truth of the financial story. It's such a vital part of the whole financial ecosystem, and honestly, probably often underappreciated. So what does this all mean for you? Well, next time you glance at a company's financial statements and you see that audit opinion attached, just remember the incredible depth of work, the layers of standards, the professional judgment that went into forming that opinion.
It's quite a process.
It really is. It's a testament to professional rigor in a very complex world. We really hope this deep dive gave you a fresh perspective, maybe sparked a few aha moments about why you can generally place trust in those audited numbers.
You know, this does raise an interesting thought for the future. Given those inherent limitations we talked about and the subjectivity and judgment, how might our whole understanding of reasonable assurance evolve, especially with new technologies like advanced AI coming into play, affecting both how companies report and how auditors actually perform their procedures?
Ooh, that is a fantastic thought to mull over.
Ah.
How does AI change the game for assurance? Definitely something to keep an eye on. Thank you so much for joining us on this deep dive. Until next time, keep learning, stay curious, and always keep asking those insightful questions.